Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage, and welcome to another edition of Java with Jared. Hope you guys are doing fantastic. I do apologize. I missed getting one out last week. I'm sorry about that. I had some continuing education in Oregon that I left on Wednesday, and I had to fly back for a family funeral early on Friday morning. Had to wake up at 4 a.m. Oregon time, get on a plane, head on back here and kind of deal with all that. So I wasn't able to get a Java with Jared out for you last Friday, so I do apologize. But wanted to get with you here this week, let you know what's going on. And as my title indicated, interest rates are rising. So I want to let you know what's going on, why that's happening, and actually what I'm telling my clients and what you can tell your clients if asked the question, what should I do about this? So here's what happened this week with economic data. We saw the producer price and the consumer price index come out. The producer price index showed a decline of 0.7% on the overall level, and producer price index measures inflation at the wholesale level, and that was the biggest drop since February of 2010. So a real big drop, much more than what economists predicted. They weren't predicting a strong number, but this was a larger drop than what was expected. The core producer, the CPI, that came out, and that measures inflation at the consumer level, which is the most important number. That showed a decline of 0.4%, also showing that there's actually maybe deflation going on. Both the core rates on the producer price and the CPI index, those came in at only an increase of 0.1%, and that excludes volatile food and energy. So energy prices were, and food prices, but primarily energy, were going down. That's why the overall rate came down even a little bit more, and the core rate, excluding those, showed basically no inflation. Inflation is interest rates' arch enemy, so that's good, and that shows that the Federal Reserve still has room to keep this quantitative easing going on. On the housing side, we saw building permits actually showed a bigger increase than is expected, a little bit over 1 million units per year. And housing starts, that showed a decline of about 16.5% to 853,000 units. That was a little bit bigger than expected, but nothing really major going on there because we've had such good numbers recently, and that is not of a major concern. So here's what's been happening. Over the last 2 weeks, we have seen interest rates go up by about 0.25 to 0.38%. So we have seen interest rates rise to about the highest levels here of 2013. Not quite, but getting kind of close. But the reality is rates are still fantastic. But that could be a little bit of a surprise to your clients. If they're not under contract yet, or just went under contract, or maybe we're floating, they might be a little bit worried because we saw rates, really, really low at the lowest levels of 2013, and now we've increased. And they might be looking to you because it's a little disappointing. Well, what to do? Well, here's what I'm telling my clients. Rates are still fantastic, and they are still extremely low, and the market is just going to be volatile. And generally speaking, my recommendation, if you like this interest rate, lock it in. It makes sense. I tell my clients that floating is like gambling. It's like, we can't predict what's going on. So I don't gamble with my house. If I feel like gambling, I like to go to Vegas. It's a lot more fun, and they give you free drinks. Lock it in if you can, because we're going to be experiencing some volatility going on. Now, for the longer term, maybe to the end of this year, I don't think that rates will continue to go up at these levels. The stock market is due for a correction. Inflation, as I said, is really low. There's still problems going on in Europe. We might not be at that, mid 3% level the whole year. But if we can get a rate of, below 4%, that's fantastic. And I think that clients should take advantage of rates where they are. Again, don't gamble with your house. Go to Vegas. A lot more fun, and they give you free drinks. So that's what I'm telling my clients. And it all started really due to the employment numbers that we saw come out at the very beginning of May. That showed that we were getting closer to that 6.5% employment rate that the Federal Reserve has said when we get to that, quantitative easing will end. We're at about 7.5%. But there's the labor force participation rate that shows that's really a whole lot of people are still not working. It's amongst the lowest levels in over 30 years. So I don't think that we're in any major threat of getting to that 6.5 unemployment rate, because more people will come into the workforce to keep that unemployment number, above that 6.5% rate. So that's what I think is going to happen. I think rates are still going to be great for the remainder of 2013, but we may not be at the level that we saw, a little bit earlier this year for the full entire year. We're going to have ups and downs, and I just kind of think that with rates at these levels, just tell your clients to lock. It's a lot more fun than gambling with their house. All right. Hope you guys are doing great. If you ever have any questions, please give me a call. Thanks for joining me with Java with Jared, and we'll talk to you soon. Bye-bye.